All right, well, welcome back once again for another bonus module, number 9. This is part 2 of our presentation, the acquisition of a real deal. So let's jump right in and look at what we're going to cover here in this module. So we're going to look at the closing of the actual deal itself, including the financing, the co-tenancy agreement, all the signatures required, the cost of closing, plus the transition from old to new management, understanding the building, meeting all the superintendents, as well as the tenants who are our customers, and reviewing the contractor list of people who've been working at the building, and then the transition year as well. So let's jump right in here. So purchase price, $4.7 million, which is pretty darn close to the asking price of $4.725. So now the conditions are removed. So now what happens? Well, what the lawyer needs to do is prepare the co-tenancy agreement, do the searches of the title to make sure there's no clouds on title, no issues with the title, so that when we take it over, everything's in good working order. They also need to create all of the mortgage documents required for the two properties. Now, in this particular case, the lender has a third party to create mortgage documents in order to assure that they are done properly. And that process in and of itself became a little bit of a nightmare because having a third party contacting us, even right up to the last minute, caused a lot of stress. Then the lawyer is also going to take care of adjustments. So if the property closes in the middle of a month, for example, then half of the month's rents have to be proportioned back to the seller and the other portion to the buyer. The taxes have to be figured out. All of the utilities have to be sorted out. So there's a lot of work involved for the lawyer doing all of these adjustments. Creating and signing all of the documents related to the property. And it all sounds simple enough. However, there is a lot of work involved here. So just to give you a little bit of a visual. So I myself, I'm in the middle and I'm sort of orchestrating this whole thing. So I'm dealing with the listing agent and the property management with respect to the property, who's dealing with the seller and the seller's lawyers. So I'm going back and forth between those three parties. Then I'm dealing with First National, that's the lender, and Daryl is my go-to person there. Then I have 5 investors that I have reached out to, and we as a group are going to be purchasing the property. I then have the buyer's lawyer, multiple inspections going on. I have to deal with CMHC and the bond market, and to top it off, here's the third party that we have to be dealing with as well. It's called the Canadian Title Company, and they were a real pain in the butt because right up to the day of closing, they were looking for documents that they didn't have, even though we had sent them to them. So they were very unorganized and unprofessional, in my opinion, company that was hired by First National to create all of the mortgage documents. So that was probably the biggest frustration. Not necessarily the most work, but the biggest frustration. All right, so with respect to financing, we had a letter of commitment from First National for 75% of loan to value at 5%, which allowed us to remove the finance condition within a 2-week window. So this is not the financing that we ended up with, but this was the financing that First National provided us because we couldn't get our letter of commitment from CMHC in time to remove that financing condition. So we continued, we removed the financing condition, then we continued with the CMHC process in order to get the 85% loan to value at 2.75% interest, so that was significantly lower. The fees associated with this, with CMHC, we had to pay out $7,950, which is $150 per door, and this is a non-refundable fee. We also had to pay $2,500 to First National as a non-refundable fee. We had to pay a commitment fee of $42,000. So this was refundable to us, but it had to be paid so that First National was sure that we were going to go ahead with the deal, because you know, if they get the money from the bond market and we don't close on the deal, then they have to return the money to the bond market, and they're going to be hit with huge penalties. So they want to make sure that they receive enough money from us that we'll be committed, but also in the event we don't close, then they can use that $42,000 to pay those fees. The insurance premium on the mortgage for the combined properties is $195,000, which just gets added onto the principal amount of the mortgage. So it's not money out of our pocket necessarily. Now, the benefits of using CMHC financing is the fact that we can go up to 85% loan to value. So that saved us $470,000 because it's 10% less that we have to come up with for the down payment. Lower interest rates also saves us more than the actual premium costs us. It's also insured for life of the mortgage, so at the end of the 5-year term, automatically will roll over into a new mortgage. They can't say, the bank can't come back and say, we're no longer interested in financing your property. Renewal is automatic. Second set of eyes evaluating the deal. So as you saw in the previous presentation, when I set the numbers off to First National, they came back at a valuation actually higher than the asking price. That is unusual. Usually the valuation from First National or CMHC comes in slightly lower than the asking price. So it's always good having a second set of eyes evaluating the deal. Now, from CMHC, what they require is for us to have a net worth of $100,000 or more, good credit scores in excess of 670. We have to provide proof of funds for the down payment. We have to provide the financials for the property that's being financed, environmental inspections. There'll be a CMHC on-site inspection, so they actually drive here or fly here from Toronto to inspect it. They need to have a co-tenancy agreement if there's partners in place. This is extremely important for them because CMHC is not in the business of running and managing properties. So in the event that there is a fallout within the partnership, and they go into foreclosure, the bank has to step in and take over the property, and CMHC does not want that. So they want to make sure that there's a good, solid contract in place between all the partners so that these types of issues can be avoided. Plus, they want to make sure that there is a professional property management company in place. Now, in our particular situation, we are our own property management company and we have the experience, so that was okay for CMHC. If this was your very first property and you haven't been managing any properties, CMHC would want you to hire professional property management for at least the first year. We had to make sure that we were securities compliant, so the government wants to avoid investors handing over their life savings, large sums of money, and having no control of it without any education or protection in place. So we make sure that all of our investors are accredited investors, meaning that in the eyes of the government, they believe and feel that these particular investors are educated and smart enough to know and understand the risks. So here's what an accredited investor looks like. It's an individual that earns over $200,000 annually, or if it's a couple, $300,000 jointly, $1 million net worth, excluding their personal home, after all debt service, or with debt service, it's a $5 million net worth statement. Owning shares of a corporation that owns an investment would require following the securities rules, which is offering a memorandum, and we didn't want to go through that process, which is why each of the partners are actually equity owners. They own a percentage of the property. Joint venture with a stranger would require an offering memorandum as well. Offering memorandum or prospectus, what that is it provides full audited details of the company and the investment. These are very, very expensive to create and very time consuming to create as well. So we would have to have the property tied up for 3 or 4 months while this prospectus is created and reviewed by everybody. And it's just a whole pile of red tape with the Securities Commission that you really want to avoid if and when at all possible. So with the co-tenancy agreement, which is a contract between all of the parties, each party owns an equity percentage and it's recorded on title. Each co-tenant then has to qualify with the mortgage and personally guarantee it as well. The agreement is required by the lender themselves. It will outline the terms and conditions which, for example, all parties involved, the equity ownership. It'll show the investment amounts, the roles and responsibilities of everybody involved, conflict resolution. So in the event that there's an issue between partners, how is it going to be resolved? It will also talk about exit strategies. So if one or more partners want to exit from the deal, there's a process for them to follow to do so. How are the profit and cash flow going to be distributed? It also talks about cash call procedures. So in the event that there's an emergency and we need to raise $30,000, $40,000 quickly and there's not enough money in the savings account, then how are we going to collect this money from the partners? How are we going to communicate with the partners? How often? How are the properties going to be managed with respect to accounting? What are the budgets and accountability? So if people fail to follow the procedures as outlined in the co-tenancy agreement, what is the accountability and how is it going to be enforced? The language of the co-tenancy agreement is extremely important as well. So you can create your own co-tenancy agreement, but I would highly recommend that you take this document to your lawyer to put it into what I call legalese. You want to make sure that the clauses within your contract don't conflict with other clauses and that they are crystal clear and everybody understands. And you want to make sure that if and when this ever has to be challenged in a court of law, that it's going to stand up and do what it's supposed to do for you. So the most recent agreement, the co-tenancy agreement, we started it in August 2014. We had two previous agreements that we worked on before, so I brought those agreements to the table and met with lawyers several times to explain what our goals and purpose was. The lawyers created several drafts which we then circulated amongst everybody. Lawyers sought third-party input from a seasoned securities lawyer in 2 different provinces to make sure that we were compliant across the board. Then all of the lawyers representing the buyers, they were involved, and they had to get independent counseling as well. The final cost was $13,528. I say it was over $15,000 because of all the work and effort that we give this particular legal office. They gave us a major discount of several $1,000s. So the value for this type of agreement, though, it truly is priceless. There is no way you should ever enter into any type of arrangement without this type of agreement in place. Now, our closing costs, the legal fees were $15,000, searches, $2,700. These were performed by the lawyer. All of the mail and fax, etc. Land transfer tax for both buildings, $67,000. The property tax that we had to pay during the adjustments was $25,000. Building inspection was $5,500. Roof inspection was actually free because it was my contractor. Same thing with the mechanical, the furnace inspections. The elevator inspection was a very reasonable $382. The environmental inspections for both properties was almost $4,800, and the insurance inspection did not cost us anything either. So a grand total of $118,000 in closing costs. That's over and above the actual purchase price for the property. Now, the transition at closing is very important when you buy a property. You have to understand the building and become familiar with it. Know its layout, where all the shutoffs are for the electrical, the gas, the water, etc. in the event of an emergency. What are all the quirks and issues that you didn't discover during your inspection of the property? Create a list of all of the accounts related to that particular property. So in our case, it was gas, electric, taxes, phone, cable, elevator, snow grass, waste removal, and others. You have to contact each of these service providers to ensure that they have all of the proper information updated in their files so that you don't have any late payments or loss of services. we've had a situation where our electricity was threatened, going to be cut off because we hadn't paid our electric bill. Well, we hadn't received it because they were still sending it to the old addresses. Then get out there and meet the people. Talk with the superintendents, find out what they actually do, explain what you actually want them to do, determine whether they're providing full value or are you getting your money's worth out of them. Listen to their concerns and suggestions. Don't just ignore them. Give them respect. Assure them that their position is safe and that you want them to work not for you but with you. Then get out there and meet all those customers, your tenants. Create a letter of introduction, introducing who you are, who's going to be managing the property, who's going to be the face they see all the time. Hand deliver the letter and maybe even consider taking a treat, a little box of Timbits or something. Expect to hear a lot of complaints, a lot of bitching and complaining about the previous owners, etc. Tenants tend to want to do that. Inform them that you will be doing unit inspections within a very short period of time, within a couple weeks, to address all of their concerns. Make sure they understand how they can pay their rent, because they're going to have to change their post-dated checks if that's what they're doing, and provide them with the new contact information as well. Then, this is really important too, find out who all the contractors are that have been working on the property and actually meet them, reach out to them. You may need them if you don't already have your own contractors in place, but it's always good to use tradespeople who are familiar with the property. It can save a lot of time and cost, and then also determine how they have been paid in the past. The biggest challenges that we incurred was the closing costs. The two buildings created double expenses in some cases. I forgot to include a prepaid clause for property taxes, which would have, even if I'd paid more for the property, include the prepaid clause, it would have saved having to bring money out of our pocket at closing. With respect to the financing, as I mentioned earlier, with First National using that third party to create the mortgage documents, that in itself was a bit of a nightmare and very, very challenging for us. Having the investors spread out all across Canada was also a challenge, because we had to get original signatures on a lot of the documents, which meant a lot of couriering, and there was always time constraints that we had to face. Canadian Title Company asking for documents one at a time and then misplacing those documents with respect to the financing. Extremely frustrating. So, the good thing though is that the only certainty is uncertainty. So, get used to the fact that it's not going to go smoothly. You're going to experience bumps and bruises along the way, challenges. Don't be surprised. Keep your cool and just move forward. Be as prepared as you can, but also be prepared to react quickly to last-minute requests and remain calm. With our one-year plan, continue to learn more about the property and the people while fostering a relationship with all of the tenants. Create a budget and review the budget on a regular basis. Have quarterly meetings with the investor updates. We do that quarterly in the first year. In the second year, we cut that in half. The end of year one, reflect and reassess any changes for year two moving forward. So that's it for module number 9. If you have any questions or concerns with support, you can reach us at info@arca-wa.com, or you can reach myself personally at apartmentwealthgeneration@gmail.com. Thanks very much and have a great day.